In 2019, a homeowner in Ontario with a 1975-built home, older systems and a clean claims record may have had an easier time getting standard home insurance. Today, that same property profile may face more questions, more documentation requests, possible surcharges, or fewer standard market options depending on the insurer. The home has not changed. The market has. I've spent nearly a decade working inside the Canadian insurance industry. In this video, I'm going to explain why home insurance has become harder and more expensive to access over the past 5 years, and what it means for homeowners approaching renewal. Most homeowners assume the increase in home insurance costs is primarily inflation. Inflation is a factor, but the more important driver is a structural shift in how Canadian insurers are pricing and accepting risk. That shift began accelerating around 2019 and 2020, and it has not reversed. 4 reasons explain most of what has changed. First, catastrophic weather losses in Canada have increased significantly. In the decade before 2008, Canadian insurers averaged about $456 million a year in severe weather-related losses. Today, insured catastrophic losses routinely exceed $2 billion annually, with some recent years reaching significantly higher. Several individual events have exceeded $1 billion in insured losses alone. Insurers price home insurance based on expected future losses. When the frequency and severity of catastrophic events increases, insurers update their risk models. Those updated models result in higher premiums and tighter underwriting criteria, not just in high-risk areas, but across the market, because reinsurers price for national and global risk portfolios. Second, reinsurance costs have risen sharply. Most homeowners have never heard of reinsurance. It matters for their premium. Insurers buy insurance from other insurers, called reinsurers, to protect themselves against catastrophic losses. When global reinsurers experience major losses across multiple markets simultaneously, Canada, the United States, Australia, Europe, they raise their rates. Those higher reinsurance costs get passed through to the primary insurers who serve Canadian homeowners, and from there to the renewal notice. Homeowners should not assume the reinsurance market will simply return to 2018 pricing. Canadian homeowners are partly paying for losses that occurred on other continents. That is how the global reinsurance system works. Third, water damage has become one of the biggest cost drivers in Canadian home insurance over the past decade. Water claims are expensive. They require emergency mitigation, remediation, potential mold treatment, and reconstruction. A single significant water damage claim can cost tens of thousands of dollars. Insurers have responded by tightening underwriting criteria around water-related risk, older plumbing, proximity to flood zones, and claims history involving water damage all carry more weight in underwriting decisions than they did 5 years ago. Fourth, aging Canadian housing stock is compounding the problem. A significant portion of Canadian homes were built between 1950 and 1985. Those homes are now 40 to 75 years old. Systems that were standard at the time of construction, knob and tube or aluminum wiring, galvanized or polybutylene plumbing, original roofs, oil tanks, can become underwriting flags, especially if they are original, unverified, or near the end of their expected life. These factors may affect whether a home can access standard coverage and at what price. In 2019, an insurer might accept an older home with original systems without significant adjustment. In 2024, the same insurer may require proof of updates, apply surcharges, or add exclusions for systems they consider elevated risk. The properties have aged. The underwriting criteria have moved with them. Here is the reframe. The home insurance market is not going to reset to where it was in 2019. The climate trends driving catastrophic losses are not reversing. The aging housing stock is not getting younger. What has changed is structural, not cyclical. The homeowners who navigate this new market well are not the ones who assume the next renewal will be easier. They are the ones who understand what the market is now responding to and position their property accordingly. What positioning your property well looks like in practice depends on where you are in the ownership cycle. A homeowner who bought in 2015 and has not updated their electrical or plumbing is in a different underwriting conversation than one who has systematically upgraded systems over the past 5 years. The market now rewards documented improvements in a way it did not consistently 5 years ago. It also means understanding that the renewal notice you receive is not necessarily the best available rate for your property. In a hardened market, insurers are not always pricing renewals competitively against new business. Your renewal may reflect where your file sat last year, not where the market is pricing your risk today. That gap is worth checking. The homeowners who fare best in this environment are not necessarily the ones with the newest homes. They are the ones who understand their property's underwriting profile, which systems are flagged, which claims are still on record, and which insurers are more competitive for their specific situation. That is information you can access. It requires asking the right questions at renewal rather than accepting the first number that arrives in the mail. 3 things that matter more now than they did 5 years ago. First, the physical condition of your home's systems. Roof age, electrical type, plumbing material, and the presence of a sump pump or water detection devices now carry more weight in home insurance underwriting than they did in 2019. A homeowner who updated their electrical, replaced their plumbing, or installed a sump pump in the last 5 years is in a meaningfully better underwriting position than one who has not. If your home has older systems, understanding which ones matter to insurers and which ones are upgradable is now part of managing your insurance cost. Second, your claims history. Water damage claims in particular have become more consequential for pricing and coverage access. A homeowner with 2 water damage claims in 5 years faces a materially different underwriting conversation than one with no claims. That does not mean you should not file legitimate claims. It means the decision to file a small claim carries more weight in the current market than it did before. Third, shopping the market before your renewal. In a hardened market, the difference between the best available rate for your property and the automatic renewal offer from your existing insurer may be larger than it was in 2019. Insurers are not always pricing renewals the same way they priced new business. Running a market comparison before your renewal date gives you information that your existing insurer may not volunteer. The home insurance market has structurally changed. The properties most affected are older homes in areas with higher climate risk, but the pricing shift has touched the entire market. Understanding why it happened is the first step to managing what it means for your renewal. The second step is knowing which questions to ask before you accept the next renewal notice that arrives. The free homeowner checklist is in the description. It covers the property factors that matter most in the current underwriting environment, including the systems that insurers are now scrutinizing more carefully than they were 5 years ago. If you found this useful, subscribe. I publish one of these every week. Everything I cover comes from nearly a decade working inside the Canadian insurance industry. See you next week.